Okay, so for this is to do with preparation of financial statements, which is the profit and loss, and then the financial position. Uh,
Mhm.
okay. What you need to know here is that when it comes to such numbers, you need to ensure that you first understand what is the nature of business, because different enterprises actually have different ways of how they prepare their financial statements. Just like the way we see this is an enterprise that deals in ladies' care products. In this paper, there is also to do with a manufacturing company. So this is more of a trading company. So they are telling us that this is the information that was available as at the year end, 31st December 2022. So this, as they are calling it, information available, is actually a trial balance. Because the trial balance is basically a list of accounts. These values are coming from the ledgers, if you remember our accounting process. So what this means is that we have land of 250, then we have motor vehicle. Now, we need to understand that these are assets. These are assets, and these are non-current assets, as we can see. But one thing I usually tell people is that not every time you see land, motor vehicle, furniture, equipment, that you should always think that these are actually these should always be non-current assets. If at all an entity was dealing in the sale of land or was dealing in the sale of motor vehicles would be their inventory. So when you see it, then you have to understand. That's why it's very important that you first understand what does this business deal in before you can even make, let's say, conclusions on each of these respective assets. So we have land, as we can see, which is valued at 250 million. There's a degree of precision here. Like I say, this is a trial balance. And that is why you're seeing this land on the debit side. We have motor vehicles still on the debit side. We also have furniture still here. We have equipment still here. So we have this so-called accumulated depreciation. So the accumulated depreciation is basically a net of our assets. Now, every time they give you these values up here, and then they also give you these values, it means that the values they have given you up are at cost. And then these are the accumulated depreciation. So over time, an asset depreciates, and when it depreciates, we compute depreciation. We have two methods that are common. We have the straight line method, and then we have the reducing balance method. Now here they have just given us the values, but when you go in the additional information, they should be able to talk about what method of depreciation was actually applied. So yours is to know that for these assets, they have depreciated to this extent. Motor vehicles have depreciated to the extent of 30,000. Now, there are cases where the examiner may not give you these accumulated depreciations, and they'll only give you the values of the assets with their net book values. Now, like I said, this is cost and this is accumulated depreciation. In case the examiner just gives you these assets as they are, they'll only give you the net book values. When we say net book value is cost minus accumulated depreciation. Okay. Are we together? Could you unmute? Okay, we are fine.
Yes.
Okay, this is to do with assets. Now, these are non-current assets, and yours is to know that when I'm now going to prepare my statement of financial position, if it is one of the things that is asked here, it means that I'm going to start with this within my statement of financial position. Now we come to these other items. Now, just like the way we have assets that have a normal debit balance, even expenses also have a normal debit balance. So we see rent here, and rent has 40,000 on the debit side. So what this means is that this is an expense actually. But in case this 40,000 was on the credit side, then in this case, this would have been an income, because incomes have a normal credit balance, while expenses have a normal debit balance. So these are expenses. So we have 40,000, 36 for 500 repairs and maintenance. Now, as we know that these will appear within our statement of comprehensive income or profit and loss in case we are going to prepare one. But always, as they appear here, they always have additional information on them. And if that additional information is there, then we have to adjust accordingly. So that is what happens with that. Then we move to the purchases. So this that I'm trying to do is for you to understand that for every item here, it has where it will go when it comes to your financial statements. And yours, you understanding where it will go is very important, so that it can even help you. You already have it in mind. When you start now preparing your financial statements, it's very easy. Then we have the purchases. Now, since this is a trading company and they're dealing in lead care products, purchases are usually two things. Purchases involve buying of raw materials for use in production, but purchases could also involve buying goods for resale. Only those two cases. Whenever sometimes the examiner wants to confuse students, sometimes in the additional information, they can say maybe purchased motor vehicle for company use. So because they have used the word purchased motor vehicle for company use, if somebody is doing a double entry for such a transaction, they want to think that they're actually going to, they are going to take that item to the purchases account. But this is a purchase of a non-current asset, which should never enter the purchases account. So purchases account only records by the raw materials for use in production or goods that have been bought for resale. That is what happens with purchases. Now, as you can see, purchases have a normal debit balance. So this is very important. And as purchases have a normal debit balance, sales for them have a normal credit balance. So that is very good to understand. Ours is also to understand that when these purchases are going to go to our profit and loss, well, we are computing for gross profit after we have our sales, less cost of sales. Under our cost of sales, we say opening stock, add purchases, less closing stock. So that is where we're going to put our purchases. And us is to know that our purchases can also be adjusted in case we have purchase returns or we have what we call carriage inwards. Yes, in case we have purchase returns, we remove them. In case we have carriage inwards, we add on them. Why carriage inwards? Is because carriage inwards is basically logistical expenses in bringing these purchases into our premises. That's why it's called carriage inwards. So things are moving inwards. There's a very similar term which is called carriage outwards. Carriage outwards is usually expenses that are actually incurred in delivering goods to our customers. Now, those ones are usually recorded under our operational costs or operational expenses. They are never an adjustment on our sales. But for carriage inwards, that one affects our purchases because in a way, it adds value to our purchases. Because if you're dealing in lead care products and you're buying them, let's say from Kampala, at let's say maybe 2 million, and you have to transport them to Arua, and that will cost you another 500,000. Ideally, the value of your products is what you bought them in Kampala plus the transport that you have incurred. So carriage inwards are added to purchases because they add value to the purchases. So that is important. Now we move to the next one, which is inventory, 1st January 2022. Now this inventory of 1st January 2022, this is, since we are looking at 31st December 2022, if inventory is being given at 1st January 2022, it means that this is opening inventory. Now, yours is ask yourself, where is closing inventory? Closing inventory, the examiner will always provide it in the closing in the additional information, and sometimes they may also give some adjustments on that inventory. But yours is to know that this inventory that is here is opening inventory, and where we use opening inventory is in the profit and loss when we are calculating our cost of sales. But this inventory never goes to our statement of financial position. Why? Because the statement of financial position looks at items at the end of the financial year. So this is an item at the start of the financial year. So for the statement of financial position, we wait to we basically only use the closing inventory. So that is important. Now, here we have our return inwards. And then we have our return outwards. Okay. Now, these are the ones I talked about. The word return inwards is also called purchase. These are basically sales returns, because returns are coming in inwards. You basically sold, now they are returning inwards. So this return inwards is an adjustment on our sales. Well, return outwards is an adjustment on our purchases. Return outwards, it is us that are returning out. So the key word here is out. You understand? Then we have carriage inwards. So carriage inwards is basically what I talked about, what is incurred in bringing the purchases. And so this one will be added to our purchases.
Then I beg for your pardon, the return outwards?
The return outwards, we are basically it's basically the deduction of our purchases.
Oh, okay.
Why? Because we purchase, now we are returning outward. So it means that it reduces our purchases value. So that is why for purchases, we get purchases, add, return. We basically get purchases, add our carriage inwards, less the return outwards to get our net purchases. Yes, to get our net purchases. And the carriage outwards, these ones are included under our operating expenses. Now, as you can see, these carriage outwards in one way or the other relate to sales. But for them, they are never an adjustment on our sales. In this case, we shall only adjust our sales with the return inwards. And return inwards, these are basically what we've sold to our customers, and they have returned those goods. Maybe we delivered more than what they needed, or basically what happened is that maybe there are faulty goods that we delivered, so that's why they are bringing them back. Then we have our capital. Now, capital is owner's contribution to the business. And capital is also sometimes, some people call it equity. But for larger entities, equity includes share capital, share premium, retained earnings, and so on. But for this number, as they are calling it capital, Ours is to know that this amount will be recorded under our equity items within our statement of financial position. Yes, and capital only changes for two things. Either there's withdrawal of capital or there's more capital that is contributed to the business. So that is where the capital may change. Then we have retained earnings. Retained earnings, sometimes it's also called accumulated profits. So this is 29 to 50. So it means that the business has been making profits, and we now have 29 to 50 million, to 50,000. Now, this could also, it could also have a loss in it, because retained earnings is cumulative in nature. So you might make 2 million this month and then make a loss of 500 next year. So when you add the two values, whatever they give you is your retained earnings.
I beg for your pardon on that.
Retained earnings is accumulated profit. And that's why it's called retained earnings. The business, instead of, let's say, giving it to their shareholders, it is retained within the business. So if this year you make 1 million, you put it to your retained earnings. Next year you make 500,000. Now your retained earnings become 1.5. In case you're not removing this money from the business. Then next year, if you make a loss of 300,000, you will get this 1.5 of year 1 and year 2 and remove the 300,000 to remain with 1.2. So that's why I'm saying that this 29 to 50 is cumulative of what has happened in the previous period.
So when it's are there cases when this figure is debited? And besides, if it's debited, what does it mean?
Yes, there are times when this figure can actually have a normal debit balance. So that means that cumulatively, the company has made a loss.
Yes.
Yes. So even when you're taking it to your statement of financial position, you now make it negative. Because
yes,
it will no longer just be added to capital, it will be actually, it will be a minus. Yes. And then, you wanted to ask something?
You first gone with that, then I ask you something. It's a bit backwards, like these items you've explained before previously. In addition to what you're saying, I've realized there is something maybe that skipped my mind. These carriage outwards, they reduce on our purchases.
No, that's the carriage outwards.
They return outwards. They return outwards.
Yes, they reduce on our purchases.
Yes, on our purchases.
Yeah.
So to me, my understanding was maybe these ones were meant to be debited, but then it's credited. So that's what I wanted more information on that. Why are they credited?
Okay, the reason why they are credited is
liability to us as an organization.
There is not a liability. Don't even talk about in terms of liabilities and what these are not spoken about in terms of liabilities and assets. These return outwards are parallel to purchases. So if purchases have a normal debit balance, as you can see there, these return outwards have a credit.
Oh.
So they are on opposite sides because they reduce each other.
Oh, to complete the double entry.
Yes, they basically reduce each other. So they operate opposite, in opposite direction, just like the way you see a carriage return, they return inwards with sales. So they return
sales and
yes, okay. Sales and credit, then this is on the debit. Yes, so it's very important to actually understand this, because sometimes the examiner just puts the word return and puts the two amounts, one on the debit side and one on the credit side. So yours is to understand that whatever is on the debit side is reducing the sales that are on the credit. And whatever is on the credit side is actually reducing the purchases that on the debit. You get it, eh?
Yes, so we can go back to the retained earnings.
So the retained earnings, like I said, is cumulative profits.
Yes.
If you make 1 million in year one, to be 1 million retained earnings. In year two, if you make 500,000, now it will be 1.5 in case that money is not being removed. And in case you make like 200,000, it will now be like maybe you make a loss of 200,000, it will be 1.5 minus the 200,000, which is the 1.3, which will be a positive.
Okay.
In case it's a negative, then you also know how to now apply it accordingly. Yes. Any questions on retained earnings?
Yeah, that takes me back to also it has come to my understanding, I've even been having hardships on this topic of changes in equity, because you always have those retaining earnings there and everything. So in future, maybe we can also have a lesson over that.
Okay.
It's also examined.
Okay, that is okay. So what are we going to do?
So these ones are treated in the balance sheet.
Yes, those ones basically go to the balance sheet.
Okay.
Yeah, these ones go to the balance sheet.